Hello, everyone. Welcome to today's edition of the Final Bar. My guest today is Tim Brackett from the Markets Compass. Going to be talking about a little bit of EM, looking outside the U.S. It's interesting as the dollar is starting to strengthen a little bit. Maybe it could be changing the way you might want to think about your overall allocations. Here in the U.S., the S&P 500 driving back higher, and driving is maybe not the most perfect way to describe it, up 1%, but certainly coming off the weakness that we saw a couple days ago. So the question obviously is this just a rebound before the next leg lower, or beginning of something further to the upside? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a relatively smoke-free Redmond, Washington. Good to be with you today, and very thankful that the air quality has improved. That was a rough week and a half for all of us here, I think, on the West Coast, and I know many still are struggling. But here in the Seattle area, things have gotten a lot better in the last 48 hours. There's this thing called rain, which we came at just the perfect time to get things ready for us. The market's sort of in this wait and see mode, and we're going to talk about the different ways we could break down the action of the last couple of days. Certainly overall still weaker rather than stronger. I think there's still potential for downside, although you could be looking at the recent couple of weeks as a bit of a wedge, a wedge sort of, after the big rally into the highs, you have the lower highs, lower lows, but a wedge pattern where there's a narrowing of that volatility, and more often than not, that resolves to the upside, suggesting that there might be further up. But we'll look at the trigger that you want to be waiting for that sort of read on the overall market. We have some great guests. I'm excited to talk to Tim Brackett from the Markets Compass today. Tomorrow, we have Leslie Juflas from Trading Live Online. On Thursday, Todd Sohn from Strategas in New York. Next week, on Tuesday, the 29th, Jonathan Krinsky from Baycrest Partners, whose work I followed for a number of years. So some great guests trying to share their thoughts, share their expertise on how they're dealing with the current market environment. Plenty of uncertainty out there. We were just talking earlier as a team about our event from today, from around midday Eastern time, introducing StockCharts ACP. We had so much fun putting on an event with John Murphy, Martin Pring, Ralph Acampora, Larry Williams, many, many more. It was a fantastic time focusing on the new ACP platform that is just officially released and unveiled today to all of our members. If you missed it, it's going up on our YouTube channel now, so check it out. And you're not going to want to miss some of those great conversations with some of the top technical strategists and traders in the industry. Let's get to our recap, and I just want to start with a poll. As we've talked on the show, I think randomly, is about the importance of routines, and I've shared with you just the general routine that I follow, doing the wrap the week on Friday, looking at the Mindful Investor Live chart list. On Monday, doing the market from three angles, top down, bottom up sectors as well. I asked all of you, when do you make time for a weekly chart review? Your choices were Friday after the close, Saturday morning, Sunday evening, or a weekly chart review. Let's leave that to the pros. It's not something I want to do. Over half of you said Saturday morning. Sort of lock in the Friday closes, lock in everything. You have your pizza night or a beverage or whatever you do. Wake up Saturday morning and dig into the charts. That's great. Vote number 2 was Sunday evening. That's where I tend to do mine as well. I sort of get to the weekend as much as possible and then start to review things. A couple of you looked at Friday after the close. I'm concerned about the 10%. This is the main reason for the question. I'm concerned about the 10% of you that don't think a weekly chart review makes sense for you. And I will tell you, if you're watching this show, clearly you find value in technical analysis and charts and visualization, and that's great. What I would encourage you strongly to do is find a time during the week, and there's no right answer. The right answer is wherever it fits into your routine and where you can stick to that. But find a time when you can review the same set of information, the same set of charts, data, whatever it is, consistently every week at the same time, look at the same set of things, because that will help you recognize when things are changing. And I would say in this sort of environment where things are relatively fluid, there's increased volatility, there's plenty of uncertainty, there are headwinds and tailwinds to any market potential future direction. now's the time to make sure you have a pretty good routine to track all of those changes. Let's continue on with our market recap. As I mentioned, the S&P certainly moving to the upside today, up 1%, with the S&P closing just above 3315. The tech-heavy NASDAQ almost doubled that, up 1.9% for the NASDAQ 100. Tech was not the number one sector, though. Consumer discretionary was over 2%. Communication services and technology, that was 1, 2, 3. So we're back to the leadership names, the groups that have sort of gotten us here, sort of rebounding. So again, if overall, that's not unreasonable. We saw the sort of short-term bullish candle patterns. You saw hammer candles, for example, and things like Apple, suggesting the chance of a bit of a bounce would be pretty reasonable. How quickly those big tech names sold off, that makes total sense. Just like a sell-off from the extreme high valuations makes plenty of sense, a bit of a bounce after the last week and a half we've had makes a lot of sense too. The real question is that next larger level. What's the real direction? We're going to look at a chart of the S&P here in a minute. Very quickly, bonds essentially flat today. 10-year yields off just a bit. Looking at commodities, gold and silver continuing to weaken. And what's interesting is gold is actually chipping away to the downside, still on the shorter term. I think long term, the chart is still in decent shape, but we're going to look at a chart here in a moment that suggests certainly some weak short-term action. Looking at a daily chart here of the S&P, what we've talked about is this, the rally to just below 3,600, the pullback to around 3,350. That was the first sort of initial line in the sand. That's made it a lower low. We've now, on this tactical time frame, had a lower low and now a lower high. This was the price bar that we saw yesterday. It might be a little hard to see, but according to a candle chart, that's called a hammer candle, which is a high and an open and close near the top of the range, limited upper shadow, a long lower shadow, which means we opened at this point, we traded down into this support range we've been talking about and traded right back up. That usually means a bit of upside potential for the next bar or two, and so today's continued upside sort of makes sense. When I talked about a wedge, this falling wedge pattern, so this is basically you have the market going higher, you have a pullback, and if you draw a trend line, I don't have them on here, but if you connect the highs and connect the lows, you can see that it's a contrary move. It's moving against the larger trend, but the range is narrowing. So these two lines are sort of diverging. And if you just take the closes, it's even more exaggerated coming in there. That pattern, what's called a falling wedge, more often than not, actually is a bullish continuation pattern. It usually means a pause before you break higher. But, and this is why I'm going to draw a trend line on here momentarily, what's important to remember is it's not a valid pattern until you actually break out. So I've seen some people on social media saying, no problem, this is a wedge pattern, this is a buy. I would encourage you strongly to remember the lessons of Edwards and McGee, of John Murphy, and many that came before me that said this pattern becomes an official pattern when you break above resistance. Until then, it's not actually a wedge pattern. That's what confirms the pattern and suggests the potential upside for there. So if we would break above that, what that basically does is highly likely you'd see a return back to the previous highs. And the first step you would need to do is get above 3,400, 3,420. That would be the swing highs most recently, because now we've had lower lows, lower highs. You'd need to see some higher highs to validate a bit more of an uptrend, a higher low as well. But until first things first, you need to break above that trend line to suggest that it's worth paying attention to. At this point, it's just telling you the short-term trend is down. Again, the bounce today makes perfect sense based on yesterday's trading, and yesterday seemed like a huge down follow-through day. We rallied back up and we're seeing a bit of a bounce. Again, I talked about that support level. I think we're going to spend a little more time down in this area. I don't think we've done enough to, sort of reset and continue up further from here. Also, we're in seasonally a pretty weak part of the year for sure. Looking at some other asset classes just very quickly, I wanted to point out, we're going to look at the UUP, which is the dollar ETF. Again, if you're looking at a longer term history, $USD is our dollar spot. It's basically a dollar index weighted against other currencies. Usually, essentially, is the inverse of the euro because it's such a big weight in there. So if you look at the euro, you'll get a similar idea to it. I'm showing this just because you can get a better intraday data for us. So you can see this rotation from distribution to accumulation. We talked about the bullish engulfing pattern that appears to have been followed through. We've now closed above the 50-day moving average for the first time since back here in May. And overall, I think we're going to see a bit more of a stronger dollar environment, this sort of a bottoming pattern that we've seen. And again, stronger dollar has implications for a lot of different things, including small cap outperformance, including U.S. versus non-U.S., just how you think about all that. A lot of things are sort of impacted by certainly by movements in the dollar. I'd mentioned gold and some of the weakness here. And again, sorry, I'm going to zoom in just a little bit so we get a better read on the chart. This is looking at the last year. We've talked about this range. So you had this big rally from June to the beginning of August, sort of settled off here while along with stocks and other assets kind of coming off all-time highs, and it's established this real steady support level right around 180, maybe just below 180 for the GLD. We broke below it yesterday, but closed back higher. Today, you actually followed through to the downside, so it feels like this support level is broken. I've been focusing on this level here, which is around 172, 172.50, and that's actually the 61.8% retracement of this June to August move is sort of down there. That also lines up with a 38.2% retracement from March to August. So I usually don't throw that much Fibonacci at a chart, but it's interesting when I see levels like this that are confluences of support, and it brings to mind conversations with Connie Brown at random conferences and stuff, talking about when different indicators, when different patterns line up with similar levels. I think you want to pay a little more attention to it. So I wouldn't be surprised if that's sort of the downside objective for the GLD. At which point, again, overall, I still think the trend is relatively productive. But again, it's going to have to break out of some of these trend lines taking the previous highs, just like with the S&P 500 as well. Unless it's moving up, the trend is not by definition positive anymore. That's our market recap for today. And again, plenty of movements right now. It's not just stocks, it's other asset classes as well. So I'd certainly take some time this week reviewing some of these different moving parts and where they all line up relative to the longer term trend. Let's take a quick break. We're going to be back with my guest, Tim Brackett. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. I want to welcome you all to the show, and thanks for joining us every weekday after the close. We'd love to hear from you, in particular, questions that you're running into as you review your own charts in your own process. We're going to do a mailbag segment a little later in today's show. We'd love to answer one of your questions in our next mailbag segment. Get your questions to us via email, thefinalbar@stockcharts.com, or on Twitter @FinalBarSCTV. If you're watching this on YouTube, just put a comment below the video and we'll capture all of those, answer your question, hopefully in our next mailbag segment. I want to welcome on our guest, Tim Brackett from the Markets Compass. Tim is joining us from New Jersey, joining the show for the first time. And Tim, it's really interesting to think about non-US markets. We talked a little bit earlier about the dollar and a potential rotation. So welcome to the show. Excited to hear your take on the world.
Hi, Dave. Thanks for having me on the show. I'd like to start with one of the features that are incorporated in my weekly ETF studies. I think you can see the spreadsheet that Dave has kindly posted. Every weekend, I go through 74 different ETFs. This one is the Emerging Markets Country ETF study. The objective technical ranking system works to help investors view the technical performance of the individual ETFs that removes any investment bias. The spreadsheet indicates the weekly change in technical ranking of each individual ETF. The system uses 8 technical condition factors that give consideration to weekly and daily trend, weekly and daily momentum, daily cloud model condition, measurements of accumulation, distribution, and relative strength, all done through a series of scripts that ask if the technical feature is positive or negative. The TR, technical ranking, of each individual ETF ranges from 0 to 50. The primary takeaway from this spreadsheet should be the trend in the individual ETF ranking. either the continued improvement or deterioration. Secondly, a very low ranking can signal an oversold condition. And conversely, a very high number can be viewed as an overbought condition. For it to be actionable, though, a sustained trend change over more than 3 weeks needs to unfold. Comparing the ranking change of one ETF to another can hint at rotation, particularly in the U.S. index and sector study not shown here. In this case, we can see the rotation by looking at the total geographical regions and see a rotation occurring there. The color encoding acts as sort of a heat map. Readings between 35 and 50 are noted in green, 15 to 34.5 in blue, and 15 and below in red. One can see the technical deterioration of the ECH at the very top, the Chile ETF, at the top of the spreadsheet. The total ETF ranking is the last row on this spreadsheet under the total EM ranking. The second chart that shows the total ETF ranking, or TER, is plotted on the top of the weekly closing price. There you go. On top of the weekly closing price of the iShares MSCI Emerging Market ETF, better known as the EEM. That is the blue line that can range from 0 to 1100, although it normally does not extend that far. The TER can be looked at as a divergence or non-confirmation indicator. If the EEM establishes a lower low, there's an improvement in the TER on the second low, a positive divergence is registered. You can see that in examples 1 and 2 that reflect those positive divergences. If the broader market is measured by the EEM continues to rally without a move higher in the TER, the continuation of that rally is in jeopardy. Example 3 and most recently number 4 reflect that non-confirmation. Secondly, the TER can be viewed as an overbought or oversold indicator, an oscillator. The closer the TER gets to the 1100 level, we know things can't get much better. The more the chance of a pullback in EM is likely in the cards. Conversely, the closer the TER gets to an extreme low, things are not going to get much worse, and an oversold rally will likely unfold. The range in the 13-week moving average can be used also as an oscillator. That's in red, and allows the same overbought, oversold conclusions. If anyone or any of your viewers, Dave, are interested in seeing more of the analysis in the weekly publications, and there is more in each one of the ETF studies, they can email me at tbrackett@themarketscompass.com, and I'd be happy to share the latest ETF studies with them.
It's a fascinating take on things, Tim, and in particular, we have about 30 seconds left, but I'm looking at the last chart. So just to be clear, we're seeing the higher highs in price. We're seeing the negative divergence from the TER, from the total ETF ranking. So similar to what we saw sort of in the first quarter of 2020, we're seeing that similar pattern, which would suggest headwinds for further upside for EM. Is that fair?
That's very fair. And, you know, the breaking of that moving average, which it had held above for, got to move something out of the way here, since April and May, is also a negative signal. You know, this works a lot like an advanced decline line, Dan.
Very good. Tim, this is fascinating stuff. I wish we could go more in depth with it, but I really appreciate you taking the time to walk through some of the analysis, in particular broadly on EM. This is good stuff. Tim, thanks so much for coming on the show.
Hey, happy to come on, and considering what the dollar's been doing, it's important to pay attention to emerging markets.
It's a great call. This is Tim Brackett joining us from the Markets Compass, joining us from New Jersey. And again, I feel at times I kick myself when I don't pay enough attention to non-US markets. It's so easy to get caught up into the flickering ticks in the US and the ETFs, the leadership themes and all that. There's so many charts we already can look at. But again, when the dollar's at a pivotal point, it's often a lot of times it's important to review non-US allocations. Now's the time to do it and just see what you're comfortable with, given potential upside or downside in some of those markets, particularly here with emerging markets. Our next segment is the Final Bar Mailbag. As I've mentioned many times, I really enjoy hearing from all of you, questions you're running into, challenges you're facing, and as much as we can help point you in the right direction through StockCharts.com, through technical analysis, we're certainly willing to do so. Let's get to our first question. Good morning, Dave. You during the show, you kept reminding us that when the RSI is overbought, there's a correction and usually one more push higher due to the strong momentum. Reviewing the chart of the XLK, I see a bounce from the day's 50-day moving average. Bounce from the 50-day moving average. Can you share your view on this chart? See if the probability for one more push higher this time too. Let's bring up a chart of the XLK. I think you were talking about this. So yeah, what we talked about was basically this extreme overbought condition. And usually if you look back in January of 2020, you've had this situation where extremely overbought, we'd always call it a good overbought, quote unquote, because what it means is the upside momentum is so strong, there's probably going to be at least one more move higher. And you sort of saw that in January to February, sort of that February move higher price, lower momentum, lower RSI, and that's sort of what sort of sealed the top, right? It sort of confirmed the fact that we were now moving higher on lessening momentum. We have not seen that yet, so we've basically seen a pullback from all-time highs with the XLK, an extreme upside move, and an extremely overbought condition. So yeah, the base case for something like this is that you'd usually see at least one more push higher, and the question is, what does the momentum do there? Now, well, your question is there a chance we see a previous high? I will tell you, there's a chance that anything could happen. So I'm going to say there's never a zero chance of something like that happening for sure. Based on the breadth conditions and everything, I don't see that as the most likely option. I'm seeing more of a bearish conditions than bullish conditions. But again, we certainly could move up to that point. I think if we would do that, I think the chances of the RSI moving back to that sort of level would be remote. So I think you have limited upside, even if we do get a bit of a rally here. And again, I think overall there's more time to be spent at the very least backing and filling here. But again, the key with any of these is you start breaking above previous resistance levels. That's what I'd be looking for. Question number 2, where are the key support levels for Apple when you're looking at the chart? Let's get to that one. So it's interesting. We've been in this situation when stocks are going to all-time highs and they keep going higher and higher. When you look left on the chart, you see nothing but clear skies. And so it's hard to really identify key support levels when that happens. The good news about a pullback is you start to be able to look left. I always talk about start at the final bar and look to the left and see what key levels are in play. Apple's a little different because a lot of stocks did not look this attractive, did not have this good of a run out of the March lows. And you can see how Apple outperformed, up significantly on a relative basis during that stretch. Most stocks have been trading higher, but, it broke above its February high here in, May to early June. And many stocks still haven't even done that or, just did that recently. So it had a very different experience than the average stock. However, there are some key points to look back at. And I think the Fibonacci levels, which we've talked about previously, are one. And I think when you've established a low and established high, I'm crudely drawing them just for speed. If you look, around 105 is the 38.2% retracement level. That's the first Fibonacci objective. We hit there yesterday. That was one of the reasons why, I suggested a bit of a bounce made a ton of sense here. And especially given the candle for the broad market, certainly spoke to some short-term positive strength. Now that we've broken, I think the next, the other key support level is right around here, 110. That was pretty, sort of the first big bounce after the sell-off. I think we've now kind of come off through that. And then the next one down, you're getting it down into this range, which is, sort of the 85 to 90 range. That's going to be the 200-day moving average. That's the swing low from July. So I wouldn't be surprised if we do break that, if we start heading down into that area. That would be the next main objective I would look for. What's key right now is the RSI hit a bottom around 40, right at the Fibonacci support level. That's usually pretty encouraging. That tells you that, that tells you we're sort of in a bull market configuration. If the RSI breaks below 40, that tells you things are changing. That's another thing I would be looking at. Hello, David. Let's see this one. So I'm having trouble bringing this up. The last 2 candlesticks tell me this is a bearish engulfing pattern. Oh, you know what? I forget actually which chart this was, but I remember this question. I'm so sorry that I don't have it. I think it was this one right here. And if it wasn't, it was something really similar to this. So here's what we're going to do. We're going to zoom into the last month. We're going to make this a candle chart. We're going to make this as easy as possible. I don't know if this was the exact example, but it was something kind of like the Apple chart. This is coming off of the high in September. You had this situation here, which was sort of a doji candle. It was a bit of an update, I think, on the example that you had sent. And then there was this down candle here. And the question was, is that a bearish engulfing pattern? So while you are correct in identifying the two pattern, the two candle pattern of one, and again, ideally this is a longer up day, and the example you sent again certainly was, and then a down day, which engulfs the previous body. That's all true, but this actually occurred in a downtrend. And what's important about a bearish engulfing pattern, which is like this example you see here, September 1st and 2nd, it's only really valid if it happens in an uptrend. So Steve Nissen, who I spent a lot of time with earlier in my career talking about candlesticks, he's really credited as bringing candlesticks to the West from Japan, where it was created. He always said the trend leading up to the pattern is what's most important, even more so than the pattern itself. So recognizing that that is in an uptrend, and then you get the engulfing pattern, that's what really makes it an engulfing pattern. So no, if it happens in a downtrend, then actually isn't valid, and I wouldn't suggest that that's the case. Next question, does it ever serve to use any price type other than candlesticks and high-low charts, as in Heiken Ashi? It's a really good question, and I probably have mentioned this before. Anytime we have a guest on who uses the Heiken Ashi candles, I think to myself, I wish I used those more, because I don't tend to, and I usually, it makes a ton of sense to me. So these look a lot like candlesticks, and again, this is a Japanese creation from years ago, and essentially regular candlesticks use the open, high, low, close. Heiken Ashi candles are adapted from that. They look very similar, but it's a modified open, high, low, close, and it does it in a way that when the trend is positive, you basically have a series of up candles. When the candles start turning lower, that means the trend really has reversed in the short term. And so, you know, the Apple going into the peak first week in September and then reversing while it comes out on the regular bar chart, while it comes out on the regular price candles chart, the Heiken Ashi chart really accentuates the rotation from bullish to bearish. Having said that, it will affect most of the indicators you're used, because if you use modified open, high, low, close, things that are calculated on the open, high, low, close are going to be a little different. So it's not something I tend to do. I have found the Heiken Ashi candles to be really interesting, because just like point and figure charts, they are meant to remove noise, which is something that I think most investors struggle with. That's all the time we have to dig into that. Maybe we can get a guest that can come on and talk in a little more detail about how they use them, and maybe we can set up a segment to really focus on them. But that's my answer to that. I think there are a lot of other chart patterns we really don't have time to get into. Point and figure charts I use pretty often, and rarely bring them on the show, just because I limited time and we have to focus at certain places. But I'd encourage you to experiment with some of the other charting styles for sure. We need to wrap the show, though. Go right to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is sort of an EM, or a non-US theme to what we talked about here. Chart number one is looking at the FXI, and I put the little underscore ahead of it to unadjust the data. So this is not adjusting for dividends. And we did that just to focus that this index actually peaked out. China peaked in April, according to this ETF, this unadjusted ETF. We didn't quite get up there in January of 2020. We did quite get up there in July, but it hit essentially that same level. 46 is the ultimate resistance for China. Since then, came off. We've now had a lower high, and now we're trading down. What's interesting about this chart is it's in a bit of a congestion, sort of a coil pattern, symmetrical triangle, lower highs, higher lows. Whichever way that breaks is usually pretty meaningful. We've arguably broken that pattern downward, which would suggest that the next leg is further down. But I think watching where it's at relative to key support around 42 would be really important on the chart of China. My guest, Tim Brackett, talked about emerging markets. I'd also point out frontier markets. Now, this is a relatively liquid ETF, but it's a very focused exposure. You're not, frontier markets by definition are relatively illiquid. It's tough to get access to some of those markets. So you're getting access to particular markets that have enough liquidity to do it. But any chart that is in a relative uptrend that's seeing higher highs and higher lows while the average market's kind of rolling over is something I want to pay attention to. So it'd be interesting to see if the frontier markets FM is able to break above 26. It's a bit of a bearish divergence with lower highs and momentum, and that's something to be wary of. The last chart is gold. We talked a little earlier about that, so I won't pound the table too much, but just to note, we've now broken down through the 50-day moving average, now broken down to a new swing low. I'd be concerned about the potential for downside, and 172, 172.50 seems like a reasonable downside objective. Folks, that is our show for today. Thanks so much for joining us for the Final Bar every weekday after the close. Special thank you to Tim Brackett from the Markets Compass for joining us, sharing his take on emerging markets. For all of us at StockCharts.com in Redmond, Washington, have a great night. Be safe. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.